There's a lot of misinformation out on social media. I want to read you something that I saw on Reddit just this week. Somebody posted this. Just close on the deal, do a cost seg study, and let the depreciation bail you out. That's basically free money, and it turns any deal into a good one. Hundreds of upvotes, a pile of people agreeing with them in the comments. I'm going to be straight with you. That's wrong. Not, well, it depends wrong. It's a dangerous way to think about a deal. If you talk yourself into buying something because of a tax benefit that isn't really going to save you, then you can lose real money. But here's the thing. Part of that Reddit post is actually true. And figuring out which part is true and which part isn't is the whole episode today. So today I'm going to walk you through how this actually works, show you the real math with real numbers, and give you a simple test you can run on your next real estate deal before you close. By the end, you'll know the difference between a study that turns a good deal into a great one and a study that's just putting lipstick on a pig. Stay with me.
Welcome to the Tax Strategy Playbook, the show where smart investors, business owners, and real estate pros learn how to win the game the IRS wrote. Each episode, we break down powerful strategies, expert insights, and real-world examples that help you keep more of what you earn. Because here, it's not about working harder, it's about working smarter with your taxes, because tax evasion is a crime, but tax avoidance is mandatory.
Welcome back to the Tax Strategy Playbook. I'm David Weiner, known by some as Mr. Cashflow. I'm a tax strategist and I work with tax professionals and CPA groups all over the country. I've provided cost segregation studies for their clients and other real estate investors for many years. That means I get to see the whole story on these deals, not just the part people post about online. I see the study before the deal closes. I see what the tax savings actually look like the year after. And I see what happens years later at the closing table when the property actually sells. That last part is the piece that nobody on Reddit ever talks about, and it matters more than you think. Today's episode is a solo show, just me. And I'm answering one question head on. Can a cost segregation study turn a bad real estate deal into a good one? I'll explain what these studies actually do, why smart people end up believing the Reddit version anyway, and where the real math backs it up and where it doesn't. Quick heads up before we get going, stick with me through the whole episode, because later on I'm going to run the numbers on an actual example deal and hand you a simple 5-step playbook you can use before you sign your next contract. If you only catch the first half, you're going to miss the part that actually changes how you look at deals. Let's start with how this actually works. Let's do a quick refresher first, because everything else in this episode builds on this one idea. When you buy a rental property, the IRS lets you write off a piece of the building's cost every year because buildings are assumed to wear out over time. For a house or apartment, you get to spread that write-off over 27.5 years. For an office, a warehouse, or other commercial building, it's 39 years. Same amount every year, like clockwork. A cost segregation study is when a trained professional walks through your property and photographs it, and then engineers identify all the pieces that aren't really part of the building's shell. Think flooring, cabinets, certain wiring and plumbing, appliances, the parking lot, fencing, landscaping. You get the idea. Those items get moved into much shorter categories, some 5 years, some 7 years, some 15 years, instead of sitting on that slow 27.5 or 39-year schedule. Here's why this matters so much right now. There's something called bonus depreciation, and it lets you take a giant chunk of that reclassified stuff as a write-off in year one, instead of spreading it out slowly. A couple of years ago, bonus depreciation was set to disappear completely by 2027. Then a law called the One Big Beautiful Bill Act, which was signed in January of 2025, changed that. It brought back 100% write-off in year one, permanently, for anything you buy after January 19, 2025, with no countdown clock built into the law right now. So picture a $500,000 rental. If a cost seg study finds that 25% of the building counts as one of those faster depreciating items, That whole piece can be written off in year one instead of trickling out over decades. That's a much bigger deal than it was 2 years ago. And it's exactly why you're seeing more people talk about this online right now. Here's the one thing I want you to hold on to, because the whole episode comes back to it. A cost segregation study doesn't hand you brand new deductions out of nowhere. It moves deductions you are always going to get and lets you take them sooner rather than later. You were always going to write off that building eventually. The study just moves a chunk of that write-off from year 15 up to year 1. That's the entire trick, and it's a genuinely useful one. But it's a completely different thing than creating value that wasn't there before. Keep that difference in mind, because it's exactly where people online get this wrong. Now let's talk about why that Reddit claim spreads so fast in the first place. I don't think people who believe this are dumb. It's actually a reasonable chain of thinking with one weak link right smack dab in the middle. Here's how the thinking goes. I'm buying a property. Cash flow is going to be tight. My cost seg study creates a big paper loss. That loss lowers my taxable income. That means I owe less in taxes or get a bigger refund. That extra cash makes the deal work. Every single step in that chain can be true. And for the right person in the right tax situation, the whole thing plays out exactly like that. The problem is the jump from that extra cash makes this deal work to that extra cash makes any deal work. Those are two very, very different claims, and only the first one is true. Here's an analogy that might help. Getting a big tax refund on a bad property is a lot like getting a great return policy on a broken product. It softens the blow. It might even make you feel okay about the purchase, but it doesn't fix the actual product. If the thing was broken to begin with, a generous return policy doesn't change that. It just changes how expensive the mistake ends up being. A cost seg study is the return policy. It's not the product. And I think that's exactly why this claim spreads. It's true often enough that people stop asking about when it's not true. If it were completely false, in every case, nobody would believe it for 5 minutes. So let's get specific about exactly which deals this actually helps. And let's split it into 2 questions, because online people mix them together all the time. Question 1 would be, can a cost seg study improve how much cash you keep after taxes? The answer to that one is yes, absolutely. And especially now with the 100% bonus depreciation back in play. Question 2 is, can it change the actual quality of the property you bought, what rent it can bring in, and what it costs to run, or what you can sell it for someday? The answer to that one is no, not even a little bit. Here's why. Depreciation is a paper write-off. The IRS lets you pretend your building is losing value every year, even though in the real world, it's probably going up in value. That's not you cheating the system. That's just how the tax code is written, on purpose, to encourage people to invest in real estate. But pretending the building is losing value on your tax return doesn't change whether your tenants are happy, whether the roof needs fixing, or whether you paid too much at closing. The real performance of your property and your depreciation write-off live in 2 completely separate worlds, and they don't even talk to each other. Now here's the part that almost never comes up on those social media posts and Reddit threads, and it's the part that should make you pause if you're leaning on a tax benefit to justify a deal. Recapture. When you eventually sell, the IRS wants some of that tax benefit back. This happens whether you ever did a cost segregation study or not. Anytime you've been writing off depreciation on a rental, you'll owe some of it back when you sell, but a cost seg study changes how the bill gets calculated. The building itself stays on that slow 27.5 or 39-year schedule the whole time. When you sell, the write-offs you took on the building come back at a tax rate capped at around 25%. But the stuff your cost seg study carved out, the flooring, the fixtures, the parking lot, come back differently. That gets taxed at your regular income tax rate, which can run as high as 37%, plus a little extra in some cases for a tax called the net investment income tax. Don't panic, though. This isn't automatically a bad trade. If you're in that top 37% bracket, you save 37% on the dollar going in, and at worst, you're only giving back 37 cents on the dollar coming out. That's basically a wash before you even factor in getting that same dollar years earlier. And that's almost always better than getting it later. And if you're in a lower tax bracket by the time you sell, or you roll the money into another property through a 1031 exchange, or you hold the property until you pass it down to your kids, the math gets way better. So here's my real point. That big write-off in year one isn't a gift from the IRS. Think of it more like a loan. It comes with a rate attached, and that rate depends on what type of property it is, your tax bracket when you sell, and how you eventually exit that deal. Treating that year one savings as free money that magically fixes a deal ignores the bill that's going to show up down the road. And most of the time, it's a genuinely good loan, but it is still a loan. So to directly answer the Reddit post, the depreciation isn't bailing anyone out. It's giving you money you were always going to get, just sooner, at a cost that's usually pretty favorable. That's a fantastic tool for improving the returns on a deal that already makes sense on its own. It's not a way to turn a bad property into a good one, because it doesn't touch a single thing that actually determines whether a property is good. Not the rent, not the expenses, not what the property is worth today or tomorrow. Let's take a quick break before we keep going. If this show has been useful to you, please take 15 seconds and leave a review at taxstrategyplaybook.com/reviews/new or on Apple Podcasts. Reviews are actually the single biggest reason new investors find this show, and I read every one of them. All right, let's get back to it. Let's get specific about why it can't fix a deal that's actually bad. Let's define what I mean by a bad deal, because I want to be fairly precise here, and the rest of the episode depends on it. A bad deal, the way I define it, is one where the fundamentals are broken, and they'd be broken no matter what your tax situation looks like. That means you paid way too much, the market you bought in has flat or shrinking rents, there's a pile of deferred maintenance that's going to eat up your cash reserves, or the property's losing real money every month with no path to getting it better. Here are 5 reasons a cost segregation study never touches any of that. Number 1, it doesn't change your rent. If you're getting below market rent because of an outdated unit or the wrong tenant mix, that's a leasing problem, not a tax problem. A cost seg study has never once fixed an empty unit. Number 2, it doesn't lower your bills. If your insurance keeps going up, your property taxes get reassessed higher right after you buy, which happens all the time and catches new buyers off guard, or your maintenance costs are climbing on an older building, none of that changes because of a tax study. Number 3, it doesn't change what the property is worth. If you paid a price where you're barely making anything compared to what similar properties in that market typically earn, that's a pricing problem. Nothing you do on your tax return changes what a buyer will actually pay when you go to sell. Number 4, the tax benefit is a one-time boost, but a bad deal's problems keep coming back every year. Let's say you got an extra $80,000 write-off in year 1. That doesn't happen again in year 2. But if your property is losing money every month, that keeps happening in year 2, year 3, year 4, and on and on and on. You used a one-time tax event to paper over a problem that actually never goes away. By year 3, the tax benefit's gone, but the monthly losses are still there. I've watched investors get genuinely caught off guard by this. They feel great in year 1 because their tax bill disappeared. Then in year 2, that write-off is gone, and now they're staring straight at a property's real problems with no cushion left to soften it. And number 5, recapture makes it worse if you have to sell early. If the deal is bad enough that you need to get out early to stop the bleeding, you may end up owing that recapture on the accelerated write-offs without having held the property long enough to actually benefit from the time value of money. In the worst version of this story, somebody does a study on a so-so deal, feels great about it for a year, holds on too long hoping the market saves them, and then eats both the ongoing losses and a recapture bill on the way out. The tax strategy didn't rescue that deal. It just made the eventual mess more complicated. So here's a simple test you can run on your next deal. Pretend the tax benefit doesn't exist at all. Look only at the actual cash flow using real rent numbers, a realistic amount of vacancy, and a real maintenance reserve, not a fantasy number. If that deal is losing money every month with no believable reason to expect the property to grow in value, it's a bad deal, and no amount of cost segregation changes that. The tax benefit should be the cherry on top. If you need it to be the whole meal, that tells you everything you need to know. Now, let's talk about where a cost segregation study genuinely does change the outcome, because I don't want you walking away thinking this tool is useless. It's just aimed at a different kind of deal than bad. The sweet spot here is what I would call a marginal deal, not a bad deal, but a break-even or slightly negative one where everything underneath is actually solid. Decent location, fair price, a believable reason to expect rents to grow over time, but the actual cash flow is a little thin, maybe a little negative, maybe just barely positive. Looking at it without any tax benefit at all, it's a pretty unremarkable deal, the kind a lot of investors would just pass on. For that specific type of deal, with the right buyer, an aggressive tax strategy can genuinely be the difference maker. And I say the right buyer on purpose because this only works if you're actually able to use the losses the study creates. Here's the part most people skip over. By default, these are what the IRS calls passive losses. If real estate is just a side thing for you, not your main job, the IRS generally says you can't use these big losses to lower the tax on your regular paycheck or business income right away. Instead, those losses get parked and saved for later, until you have other rental income to offset or until you sell. This is exactly the gap that trips people up online. Someone posts their huge tax savings without mentioning that they qualified in a special way, and everybody assumes the same result applies to them too. It usually doesn't. There are two common ways to actually unlock these losses right away. One is qualifying as a real estate professional in the eyes of the IRS, which basically means real estate is your main job, more than half of your working hours and at least 750 hours a year spent on it. The other is what is widely known as the short-term rental loophole. If your property is genuinely a short-term rental, Airbnb style, with an average stay under 7 days, and you're the one hands-on running it, you may be able to use these losses against your total income, whatever the source, without needing to qualify as a real estate professional at all. But it only works if the property is actually a short-term rental. If you're renting it out on a normal year-long lease, this particular break just doesn't apply to you, full stop. For someone in either of these two situations on that marginal deal, this strategy can turn a mediocre spreadsheet into a genuinely good one once you look at it after taxes. So the honest, complete version of that Reddit claim isn't cost seg can turn a bad deal into a good one. It's really cost seg, for someone who can actually use the losses, can turn a marginal deal into a good one after taxes, especially in the first year or two. That is a much narrower claim, but it's also a true and useful one. Let's put real numbers on this so you can see exactly how it plays out in real life. Let's build an example and run it two ways. First, as a marginal deal, then as a genuinely bad one, using the exact same cost seg study both times so you can see clearly where this tool helps and where it stops helping. Before we even get to depreciation, there's a step that has nothing to do with cost segregation and everything to do with getting the basic math right. Figuring out how much of your purchase price is land versus building. Land itself never depreciates, ever, whether you do a cost segregation study or not. So the very first thing you or your tax professional does on every property is separate out the land value, usually using the county tax records or an appraisal, because only the building part ever qualifies for depreciation in the first place. So here's our sample property, and I want to be specific about one thing up front. This is a short-term rental, the kind you'd list on Airbnb or VRBO, with an average guest stay of 7 days or less. I'm stating that clearly at the start because it really matters for the math. Because later in this example, we're going to use a tax break that only applies to short-term rentals. You can't get that break on a long-term rental, and you can't mix and match the two. Let's say it's a $500,000 property, and the tax assessor's records show land is worth $100,000, which leaves $400,000 as the building value or depreciable cost basis that can actually be depreciated. That land split happens no matter what, with or without a cost segregation study, and no matter whether it's short-term or long-term. Here's a detail that catches a lot of short-term rentals off guard because this property is rented out in such short stays, the IRS treats the building itself more like a hotel than a regular long-term rental for depreciation purposes. That means the building portion gets written off over 39 years, not the 27.5 years you'd use on a normal long-term rental. Using the standard method with no cost seg, that $400,000 depreciable basis gets written off over 39 years, which comes to about $10,250 a year, every year, flat. Now let's bring in the cost segregation study. A typical study on a property like this finds around 25 to 40% of the building qualifies as one of those faster categories: flooring, cabinets, certain wiring and plumbing, appliances, fencing, the driveway. Let's be conservative and say it finds 25%. That's $100,000 worth of stuff. And thanks to the 100% bonus depreciation we talked about earlier, that whole $100,000 can be written off in year one. Add in a partial year of regular depreciation on the remaining $300,000 at that same 39-year rate, roughly $7,700, and your total year one write-off comes to about $107,700. Compare that to the $10,250 you'd get without the study. That's about $97,000 of extra write-off, all pulled into year one. Now let's put a real person behind this deal. Say they're in the top 37% tax bracket, because this is genuinely a short-term rental with an average stay under 7 days, and they're the one actually running it. They qualify for the short-term rental loophole we just talked about. That means these losses directly offset their total income dollar for dollar, not just business income, their total income, no matter where it comes from. A job, a business, investments, any of it. That $97,000 extra write-off is worth about $36,000 in actual tax savings just in year one. So in scenario A, the marginal deal, before we even think about taxes, this property runs about $8,000 negative for the year once you add up the mortgage, taxes, insurance, a maintenance reserve, and a property manager. Not a great deal, not a disaster either. The kind of thing a lot of investors would look at and think, maybe this market bails me out eventually. Now add that $36,000 in tax savings, and suddenly this property is pulling about, now add that $36,000 in tax savings, and suddenly this property is putting about $28,000 in your pocket for the year after taxes. That's the difference between a deal you regret and a deal you're genuinely glad you did. The bones of the deal were solid: decent price, decent market, thin margin, and the tax strategy pushed it firmly into good deal territory for this particular buyer. Scenario B is the actually bad deal. Same exact study, same $36,000 in tax savings, but this time the buyer overpaid, rents in the market are flat, and the property is losing about $40,000 a year in real cash flow, a genuine ongoing problem. Add that same $36,000 in tax savings, and you're still down $4,000 for the year, even after using the biggest tax tool available. And remember, most of that $36,000 was a one-time event. By year two, once that bonus depreciation is used up, you're back down to roughly $7,700 in regular depreciation, worth maybe $2,850 in tax savings. Against a $40,000 a year loss, that barely moves the needle. The deal that looks survivable in year one is clearly underwater by year two, and it stays that way for the rest of the time you hold it. Here's the part that makes it even worse in hindsight. If this investor gets uncomfortable, and decides to sell in year 3 or 4 to cut their losses. They're now facing that recapture tax, ordinary income rates up to 37%, plus that extra 3.8% in some cases, on the accelerated portion of the depreciation they took. They took the deduction at 37% going in, and now they're giving a real chunk of it back on the way out, on a property that lost them money every single year they owned it. The tax strategy didn't save this deal. It gave them one good-feeling year and a messier exit. Same exact tool, same $36,000 benefit. On one deal, it's the difference maker. On the other, it's a rounding error against a problem that was never going to get better, and it might have even made the eventual reckoning worse. That's really the whole episode right there in one comparison. So how do you actually use all this on your next deal? Let's turn everything we just discovered into 5 simple steps you can run before you ever sign a contract. Here's your checklist. 5 steps, and you can run through all of them before you're even under contract. Step 1. Look at the deal with no tax benefit at all. Pull the depreciation write-off completely out of your numbers and look only at real cash flow. Actual comparable rents in that area, not the optimistic number on the listing, a realistic amount of vacancy, a real maintenance reserve, and your actual interest rate. This is the foundation. If you skip this step, everything else in this checklist is standing on nothing. Step 2. Ask yourself the zero benefit question. Just ask yourself one plain question. If I got zero tax benefit from this property at all, would I still want to do this deal? If the honest answer is yes, even a soft yes, you're probably looking at a good deal or at least a marginal deal, and a cost-seg study is going to genuinely improve your outcome. Go ahead and use it with confidence. If the honest answer is no, if the deal only works because of that first-year tax write-off, that's your red flag. That's the Reddit trap happening in real time on your own deal. Step 3. Make sure you can actually use the tax losses. Before you assume a cost-seg study is going to help you, call your accountant or your tax professional and ask directly, given my situation, will these losses actually lower my tax bill this year, or will they get stuck and saved for later? If you're not a real estate professional and you're not using the short-term rental loophole we talked about, and this is just a passive investment for you, there's a real chance the answer is stuck. You want to know that before you close, not after you file your taxes. Step 4, look at the exit, not just the purchase. Ask your tax professional to walk you through what the recapture tax would look like if you sold in year 3, or year 5, or year 10. You want to see the full picture, the write-off you get now and the bill that shows up later. If a deal only looks good because of the year 1 tax savings and it falls apart once you factor in a realistic exit, that's not actually a good deal. That's just a good year. Step 5, once the deal passes the first 4 steps, add the cost segregation number in as a bonus, not a reason to buy. Once you know the deal stands on its own from steps 1 and 2, and you know from steps 3 and 4 that you can use the benefit and understand what happens at the exit, go ahead and run the cost seg study and add those tax savings to your expected returns. At this point, the tax strategy is doing exactly what it should, making an already deal even better instead of trying to prop up a bad one. Run those 5 steps on your next deal in order, and within about 10 minutes, you'll know whether you're looking at a deal that a tax strategy can genuinely make better, or a deal that's asking the tax strategy to do something it was never intended to do in the first place. That's the real answer on cost segregation and bad deals, not the Reddit version, the actual one. So, quick recap. A cost segregation study is a timing tool. It moves write-offs you were always going to get from later years into year 1. It can turn a marginal break-even deal into a genuinely good one for the right buyer. It can't fix a deal that's broken at its core. And if you're leaning on the tax benefit to make the numbers work at all, that's your sign to walk away, not close. And if you remember only one thing from the 5-step checklist, remember this. Look at the deal with no tax benefit first, Ask yourself the zero benefit question. Make sure you can actually use the losses. Look hard at the exit, and only then add the cost segregation savings on top. Do those 5 things in order, and you'll never again mistake a bad deal for a good one just because of a write-off that looked big. So if this episode kept you from underwriting your next deal around a tax benefit that was never really going to save you, share it with the investor friend in your life who's 3 tabs deep into a Reddit thread right now, convincing themselves that a marginal deal is a great one. And 2 quick asks before I let you go. If you're watching this on YouTube, hit like before you close the tab. It genuinely helps this show reach more investors. And if you want breakdowns like this in your inbox as soon as they go live as an episode, subscribe to the newsletter at taxstrategyplaybook.com/newsletter. Newsletter subscribers also get free access to Playbook notes for each episode, as well as some other resources like my 2026 tax planning guide. If you want help figuring out whether a specific deal of yours belongs in the cost seg makes it great pile or the walk away pile, that's exactly the kind of conversation I have with clients every week. I'd be happy to run a no-cost preliminary analysis for you or discuss the topic at any time on any property that you either own or are looking at buying. My contact information is in the show notes, and I'd love to talk with you. I'm David Weiner, Mr. Cashflow. Thanks for listening to the Tax Strategy Playbook. I'll catch you on the next episode next Tuesday.
Thanks for listening to the Tax Strategy Playbook. If you found today's strategies valuable, be sure to subscribe, leave a review, and share the show with someone who wants to play smarter with their money. You'll find more resources, tools, and expert tips at taxstrategyplaybook.com. After all, it's your money. Keep more of it.